Good afternoon, and thank you for joining us today. I'm Nick Wright, Director of Jerroms Miller Specialist Tax, and I'm joined by various other directors within the Jerroms Group to bring you immediate thoughts on the spring budget that we've all just watched. So, just to introduce you to everybody that we'll be talking today, we've got Lucas, who's a director of Jerroms Group. Jamie Ellis from Jerroms Financial Planning, Kate Moon, a head of private client and director of Jerroms, Pete Miller, head of corporate tax and director of Jerroms Miller, Mark Flower from Jerroms Mortgage and Finance, and David Fletcher, MD of Jerroms Corporate Finance. So as you can see, we've got quite a range of us, and hopefully we can cover pretty much every aspect of the budget that came out today. Although some of us, I think, will be talking a lot more than others, and we'll bring you our initial thoughts. So we hope that you'll find this webinar informative. Obviously, the budget was finished at somewhere around 1:45, I think it was, and following which the Red Book was published at just after 2 p.m. So we've spent about 2 hours swatting up on what the Red Book says in very quick time. So it didn't seem like actually there was an awful lot more in the Red Book than actually was announced, which is fairly unusual, I think, in my recent experience of analysing. But if anyone has any comments, thoughts, questions, please pop them in the comment box, and we'll see if we can get to them as we go through. Otherwise, we'll hopefully have some time at the end for some questions as well. We've already had one question, actually. When can we expect a general election? That's a good question. I'm not sure there is an answer. I know that it has to be, I think, by the 24th of January. But other than that, I think most people are expecting it a lot sooner than that. So we shall see. And actually, an interesting point, as you go through, you'll see a lot of the measures that have been announced. There's some immediate points and changes that will occur from April 24. But actually, most of the points are actually going to be brought in either from April 25 or April 26. So it's a good question. And in reality, how many of these changes will, what government will we have by April 25? And will some of these changes actually be followed through by whichever government we have? So that's as much as I can answer, unless anybody else has any other thoughts on that point.
I think the other point to say is, this may not be Jeremy Hunt's last crack. He may have an autumn statement yet before we even have a general election. So there may be further cards dealt.
Yeah,
I think though that in terms of the actual timescale for legislation, if anything is announced any later in the year, there just isn't going to be time to squeeze it into another Finance Act before the election. So unless a future government is kind of minded to follow the same policy in any particular area, there's an awful lot of this stuff that may never see the light of legislative day.
You're going to make people switch off, Pete, before we've even got into it.
Yeah. We're going to give you a load of stuff that ain't going to happen. Enjoy.
Right. So moving into what we've kind of picked up as the main points. Jamie, if I kind of start with some of the pensions and savings. Well, it's called pensions and savings in the Red Book, but actually there's very little on pension. So savings, we've got a new ISA that was announced, haven't we? Which is, I think you tell us about it.
Yeah, so obviously Jeremy Hunt has today announced the implementation of a British ISA to encourage investment into UK assets. I think if you look at London Stock Exchange listings over the past 6 years, they've been at an all-time low. We've also had a number of delistings as well. So what they're trying to effectively do is try to encourage investment into UK assets. I think what the important thing to note is, 85% of individuals don't currently use their full stocks and shares ISA allowance. And so this seems like a fairly, it seems like a tactic aimed towards wealthier individuals who will have that allowance remaining. At the core of everything we do in the financial planning arm, it's very important that we globally diversify our clients' monies, which are at the backbone of their financial plan. And it's important to remember that the UK accounts for 3% of global GDP. And so our clients' investments and the underlying investments within their financial plans, they're not heavily skewed towards the UK, which has underperformed compared to the US and the global all-world index over time. And so this seems more of a symbolic measure to try and encourage investment onto the stock exchange. But whether it is actually taken up and whether platforms actually implement this new tax wrapper on their systems, then that's another question.
Yeah, so this ISA is specifically, so it's a £5,000 limit per year,
Yes,
and it's
correct.
specifically for investments into equities, isn't it? So it's not a cash ISA.
No, that's it. So it is investment into equities, and I think it follows the previous personal equity plans that we had that were abolished in 2001. It will be very interesting to see how they classify what is classed as UK equities, because obviously the FTSE 100 is predominantly made up of global banks, energy companies, etc. And so it would be interesting. And I know there's a consultation to come with no fixed timescale as to when this British ISA will be introduced. So it's more of a watch this space, really.
Yeah. What about pensions? So, as I said, I don't think there was anything actually noted on pensions specifically. I think there was some sort of promise that they were going to remain committed to a lifetime provider model for defined contribution schemes. But other than that, I think it was pretty light on pensions, wasn't it?
Yeah, so that's it exactly. So what the UK is doing is they're looking at where can they raise funds to boost UK businesses and the UK economy. Obviously, compared to other geographical regions, there is a much the UK investors have an underexposure towards the UK sector, and that has been because of Brexit and other factors, and the fact that the UK markets haven't performed as well as other global sectors. I know that UK markets the FTSE 100 has one technology stock on the whole indices, and so individuals and investors looking for higher growth do tend to look overseas. But the point is, there's billions of pounds to be unlocked there by way of pension investment, by potentially saying that UK pension individuals must allocate a specific percentage of their wealth towards UK companies. But how that will be implemented, again, time will tell. The other point was then on the pot for life. Currently, the onus is on employers to enrol individuals into workplace pension schemes, and that can be a scheme of their choosing. Obviously, you've got the government schemes such as Nest, and there's other schemes such as the People's Pension, Royal London, etc. But the new reforms aim to encourage individuals to be able to choose where they want their employer to pay their pension contributions, which no doubt will cause a headache for payroll and other services. And when you look at the pensions dashboard that was meant to be introduced, and that's been in work for many time, I think this is going to take many years to even go past the consultation phase.
Yeah, and obviously by then, as we've already said, we'll be into certainly a different chancellor and probably a different government as well.
Yeah, that's it.
Right, let's move to
just to say that there was no changes to the annual allowance. The lifetime allowance has previously been abolished. Whether Labour reinstate that, that is something that they have spoken about. Labour have recently said that there wouldn't be a carve out of any public sector pension schemes such as the NHS. So again, it's moving goalposts all the time, but highlights the importance of just knowing what your allowances are and making the most of everything as well.
Absolutely. Let's move on to personal tax. So Kate, I'll be picking on you a lot now.
Okay.
So the first, I guess one of the first things, which actually we both have young children, and Lucas, Jamie, quite a few of us on this call actually have young children as well. So the first one is high income child benefit charge. Now this one was actually something that quite a few people were kind of predicting. So that seems to be another theme of this budget. Quite a few predictions came true for once. So
Yeah.
currently we have
I
a
mean,
high income child benefit charge anyone over 50,000.
Yeah, so there's always been this disjointedness where you've got two people in a household earning, say, 49,000 each and getting the child benefit, and then you've either got a single parent household or perhaps a household where only one parent works because of the young children, where the income is more than 50,000 and they haven't got the benefit of that. So they're trying to correct that. Disappointingly, they don't seem to be correcting it in full until the earliest of 2026. So they're trying to put something in place where it's based per household rather than per person. So they are increasing the threshold from 50,000 to 60,000 straight away from 6th of April 24. And the taper has changed as well. So before it was if you were over 50,000, you could go up to 60. And once you got to 60, you lost the whole amount. Whereas now you'll be able to go up to 60 to start with. And then that taper won't fully kick in until you get above 80. So it's definitely going to help people, but it's not particularly made it as fair as it could be, I don't think. So you're going to have to wait until 2026 for the change to be brought in for it to be per household.
Yeah, and I think when he was speaking, he was talking about this is actually a consultation. So it's not that they're just looking at it themselves; they're actually consulting, aren't they, with, I presume, the public and other bodies.
So I think it will help some people in the short term, but it still doesn't really make it as fair as it should be.
I wonder, though, if there's another angle on this, which is that by doing something fairly public about it and announcing it in the budget, is it going to give HMRC ammunition for any future cases arising after today, to say that people have even less excuse to be ignorant of the law? Because hitherto, in a number of penalty cases, the revenue has lost on the basis that the tribunals and courts have held that this is something that nobody knows about.
Yeah, which I think is a bit of a tall tale. And we've all told them to get clients out of penalties or out of interest situations. But I think you'd be hard pushed to say that you weren't aware of it, even before this budget, I think. However, there has always been this case of why hasn't HMRC got access to them records? Because we've had clients where their P60 clearly shows that they earn, say, 100,000 a year. And you almost think the record should marry up, but it seems to take HMRC a good few years to actually cotton on and say, you owe us this child benefit for the last 4 years. So that seems to be where it falls down as well, is the communication between the people paying the child benefit and then HMRC actually having that payroll information. And RTI was always meant to correct that. That was the whole point of RTI, is that they've got real-time information and they can deal with things smoother. It just doesn't seem to happen. So I do feel for clients on that basis, but I do think you'd have to be living under a rock to not know that there was a limit on it. But yeah, it's very disjointed.
Yeah, I think it's actually interesting because it took me 3 attempts to actually call HMRC and say that my wife is receiving high income child benefit. So I called them once and I said, "Can you change my tax code?" Nothing happened. 2 months later, I tried again. So it's not even the taxpayer sometimes.
No.
No. But yeah, I think the interesting thing was he was kind of saying that it's quite actually to consider household income in the way that we would need to is actually quite a task in itself. So I think that's why they use.
They do it for lots of other benefits, don't they? They do it for working tax credits, children's tax credits. There's lots of other benefits that are all based on household income. So it just surprises me that this never has been.
No, it seems like such an obvious one that would be based on household income. So it's almost like, why was this not done from the start?
But what do they mean by household income? Most of the cases that have gone in front of the tribunals have been about cases where the couple live apart. So they actually didn't know each other's income, or one didn't know the other was claiming, or whatever.
I think the
So
point is
it's
that the
interesting to see
new
what this
rules,
household thing is going to mean.
yeah, the new rules are going to be based on household income, whereas the old rules are just if there is a spouse with a high, well, okay, you can explain it better, but with a spouse
Yeah,
with the excess income, isn't
it
it?
is, and there's some really funny rules with child benefits. So if you're separated, so me and my ex-husband, I can claim child benefit if I want to, and it wouldn't matter what he was earning because he's not living in the same household as that child. But then if I was living with a new partner who was earning over that amount, that would matter. So it's not even about the parental relationship with the child. It's more about who's living in that household. So they've almost based some of it on who's in the household in terms of who catches you out for going over the limit, but then not done it on household income. So it's a bit of a strange one. They seem to have considered it, but then not completely followed through.
Yeah, and just to bring in a comment that we've had from Keith, the changes to the high income child benefit can have implications to who is regarded as the responsible adult for getting the NI credit. Currently, this can be a grandparent. So if household income is the factor, some changes might arise for NI. So yeah, I think there's quite a lot involved here.
Yeah, definitely.
Even though potentially, if you look at the wider scheme, then actually it doesn't look like a significant tax, but other than for those affected, obviously. Whereas, yeah, obviously, to actually legislate what we're talking about is perhaps a bit more of an issue. Okay, should we move on to national insurance, because that's another one that was announced, which I actually was surprised it was as high. So what they've done here, they've cut national insurance, both employees' national insurance, by another 2%. So they already cut this by 2% in November. So it's actually a 4% cut since November. The additional 2% will be coming out apply from April, and the same will apply to class 4. So we've got apparently it equates to about a further £450 in savings. Jamie, I know you had some thoughts on that.
Yeah, I mean, again, I remember Rishi Sunak pledging that basic rate income tax would be cut to 16%. That was only back in 2022, but it just seems that with the fiscal headroom that the Chancellor has, it's obviously much easier for them to cut national insurance as opposed to income tax. With the fact that the triple lock is remaining where they are, obviously national insurance reduction doesn't benefit retirees. So it's aimed at the unfair double taxation treatment of people in work. And so effectively, over and above the personal allowance, which is £12,570, for every £10,000 earned over that, then an individual would save £200 per annum. So if you've got an employed individual who's a higher rate taxpayer, i.e. earning over £50,270, then they will have a national insurance saving of £749 moving forward, which all sounds great. And this was the rabbit that Jeremy Hunt pulled out of the hat last time. But to be honest, it wasn't met with a great reception, because people are just receptive now to the fact that, we've got these stealth taxes by the freezing of income tax thresholds. So again, giving with one hand, taking from another. But obviously for, working families, younger families, the NI reduction and the uplift in the high income child benefit charge is obviously will be welcomed. They're obviously trying to target a voter base that isn't their core demographic, and that's probably where they feel that's where their efforts are best focused. So I think this move in itself would cost them, the Treasury, 10.5 billion. So it is a very expensive policy to implement. And the only thing I'd add is really where you've got pension schemes, company pension schemes operated by way of salary sacrifice, then pension savers should just be aware that the rebated employee national insurance is obviously going to be reduced as a factor. So you might see monthly contributions coming down for individuals in workplace pension schemes as well. But overall,
Right.
for your average earner, they should be saving around £450 per annum. High rate taxpayers around £750. So, yeah. it all depends on your own position.
Also, just to say, I assume because national insurance isn't devolved, then this helps Scotland as well, doesn't it? The 1% NI reduction, whereas a personal tax reduction wouldn't help them with it. So
no, that's is the interesting point, isn't it? That actually this is going to apply to the Scots as well. So
maybe.
I know that's. Oh, sorry, Nick. I was just going to say, I know that's a contentious issue. They don't want nationalism arising. So, obviously, income tax was devolved many years ago. National insurance is still set and administered by Westminster. So, yeah, again, that's probably another reason why.
Yeah, absolutely. Okay, so that's national insurance, and as I say, actually, it's interesting because it seemed early on people were predicting the 2%. Then people were thinking, well, maybe it's not going to be so much, it'll be 1%. And I actually thought maybe it's not going to happen because of a few comments he made over the weekend. But so it did happen. We got 2%, which certainly for the sort of lower paid families, they'll definitely, £450, I'm sure will be worthwhile. But so the next issue on personal tax side is the so-called non-dom regime. I've always called it the remittance basis, but the non-dom regime seems to be what the media call it. So the remittance basis is planned to be abolished from April 25. What this means in layman's terms, because it's basically since I studied CTA that was the last time I got involved in this. But so typically a UK resident individual, whether you're domiciled here or were born overseas, you'll be taxed on your worldwide income and gains. If you're non-domiciled, though, you can make an election. And I think it's still 30,000. Kate, you can correct me if I'm wrong. 30,000 charge in order to be taxed only on the money that you bring back into the UK. So if you've got overseas income, then potentially you could exclude that from your UK tax liabilities. Kate.
What you said is spot on. The remittance charge, so non-doms can choose to just be taxed on the income they remit. For the first 7 years that they're resident in the UK, there's no charge, but then the 30,000 kicks in year 8. It does go up when you get to, I think it's 15 years. I've yet to see one, but it goes from 30,000 a year to 60,000 a year, which is quite a substantial charge. So obviously very much aimed at people that have got very high income abroad. If your income abroad was less than 100,000 in a year, then it probably wouldn't warrant you paying a remittance basis charge. There's not much detail announced on this yet, I imagine, because it's not going to come in until April 2025. They're going to consult on it quite a lot. So there's not that much I can tell you. They are putting in some new rules that will allow for anyone that arrives after April 2024 to come into a new regime. So even though it doesn't kick in from April 25, I think we might hear a little bit more about how new arrivals could expect to be treated. So you're going to have 4 years where you've got no tax on your foreign income or gains. Similar to Italy do it, Portugal have had it, where Portugal call it a non-habitual regime. And I think they've just closed the door on the Portuguese one. But it's where you're basically allowed to have all your foreign income and gains and not pay tax on them for that first 4 years of coming to the UK. So that will be attractive to people. What's interesting is there's going to be transitional arrangements for people that are currently resident in the UK that are non-dom, where you're perhaps, it's suggested that you can be able to rebase your capital asset, and you're going to get exemptions for your foreign income and gains for the first 1 year of the new regime, regardless of how long you've been resident in the UK. But the most interesting one is there's going to be a 2-year window in this transitional arrangement where you can arrange to bring existing offshore income and gains into the UK for a flat 12% tax rate. Whereas at the moment, if you were to remit £1 million of a capital gain, you would have to pay, you'd have to declare that £1 million at capital gains rates in the UK. So nothing is ever going to be as attractive as a 12% tax rate. So I think the main aim of this is going to be to encourage people that have still got a lot of income offshore that are living here to actually use that 2-year window to bring all that wealth into the UK. So that will be really attractive to people. And, you know, if anyone was planning to remit money in the next 12 months, you'd potentially be saying, well, hang on, let's wait and see, because if you can delay that remittance until this transitional window, you may be able to get it all into the UK with a 12% tax rate. but it's all very vague at the moment, so there's not that much detail on it. But it's certainly one to keep an eye on. Could be used to people's advantage, definitely.
Yeah, so there's potentially quite a lot of planning to get involved with here, but we can't really do an awful lot until we know more, can we?
No, not at all. But yeah, I think certainly existing non-doms, the planning side of it could be huge.
Yeah. Okay. So that, I think that covers most of the main personal tax things that have come out of today's budget. Let's move on to property. There were actually quite a number of property changes as well. And again, the first one I wanted to talk about is one that I saw quite a few people predicting, which was about furnished holiday lets. And in this case, they have announced that they're completely abolishing it from 2025. So the furnished holiday let regime basically says if you meet certain criteria, which is the length of time that you let a property out, how long it's available to be let to the public, those types of things, and there's limits on the number of days, so it has to be kind of short-term lets providing furnished properties for holiday purposes, basically. So this has enjoyed quite a lot of benefits over the years. So the main thing is that many areas of the tax legislation treat an FHL business as a trade, which all other types of property investment are not considered trading businesses. So there's various tax reliefs that have been available. So and I think this is probably one of the areas that they've announced as potentially being able to pay for some of these tax cuts that we've had in the national insurance. The main thing being, other than the certain capital gains release, because it's a trading business, so business asset disposal relief could potentially apply here to pay 10% on the sale of an FHL business. If you gift it, there's gift relief possibly available. But the big thing, I think, one of the immediate impacts is going to be the loss of capital allowances. So capital allowances generally are not available on for assets in a residential property, but FHL have a specific exclusion, so capital allowances are. So that's FHLs in a nutshell. We are expecting to see an abolishment of this by 2025. Pete, when we were speaking earlier, you had some interesting thoughts about how this might impact on things.
Well, I hope they're interesting thoughts. Certainly, I mean, I can see that to some extent this is a money raiser. Because of the fairly generous tax reliefs for trading compared to investment activity, bringing furnished holiday lets, which are effectively, usually at least, an investment activity, into the trading regime, as it were, was obviously going to save a lot of tax for taxpayers, depending on the reliefs that you mentioned that they're able to access. So I can see that this is a money raiser, and in a way, fundamentally, that might be all that's going on here. But in terms of talking, as he did, about fairness and so on in his speech, the thought that occurred to me was, yes, I can see that logically this is really an investment activity and should be treated as such. But on the other hand, I'd understood many years ago that the furnished holiday letting regime was intended to some extent at least, to encourage tourism in various parts of the country. And I know there are parts of the country that you and I and others on this podcast, as it were, have all dealt with in our times, where companies have quite a lot of properties, sometimes even hundreds, in areas of the country which are well known for their tourism, and that to that extent, I would have thought the furnished holiday lettings industry was a net positive for areas which, apart from natural beauty, might not have much in the way of resources. So, for example, areas like Cornwall and Devon and some parts of the northeast coast and so on. So I wonder if anyone's actually done a sort of discussion with interested parties as to the balance between that and, on the other hand, perhaps if you can't get the tax reliefs for it being treated as a trading business, you end up saying, well, in that case, I'll just sell off my portfolio, and maybe your doing your bit, as it were, for the housing market more generally. So I guess it's a balance, isn't it?
Yeah. Mark, I'll finally come to you for to talk about something as well, because I know you also had some comments on the FHL point as well.
I did. This is the stupidity of government, isn't it? Of Treasury. Everybody's bleating at the moment about the cost of for renters. Rents are going up everywhere. Cost of living, people can't afford. They can't afford to get a mortgage, so they have to rent. But the cost of rent is high. And what's the reason for that? Is because years ago, when they did the same treatment for landlords, for people who thought, I'll have a diverse portfolio and I'll buy a property that I can let out, and that'll be my pension. And then suddenly all their tax advantages, and they start raising 3% levies on the stamp duty, etc. So they start disposing of the properties, and there becomes less stock for the private rental market. Now we find the same with today now with holiday lets, where people bleat all the time, oh, all these people that come and visit these towns, etc. But it's too much, and there's nowhere for anybody to live, for locals to live, etc. But the amount of money that they bring into that area, they either want it or they don't. And my understanding was that it is a massive tax raiser. The holiday industry is a massive contributor towards Treasury, and to, as Pete said, areas where you wouldn't normally buy a property for standard letting. And it's just, in my view, not joined up. Thankfully, when they did it in the private rental market, lenders had to rush to get limited company products out, and they did. And now there is such a wide range. There's more limited company products than there probably are for individuals buying a property, because they're becoming less and less. Most of our buy-to-let business is for limited companies, and perhaps this will move the same way for the holiday let market. But it certainly doesn't help people who've already got properties. I just find it confusing, and as Pete said, I think it's literally just a quick fix money raising exercise.
I mean, actually, one of the prediction articles I read basically said FHL, they expected FHLs to be abolished to pay for them. So yeah, I think most people think the same.
If I can just
so is it, do you think he's picking and choosing his?
Sorry, Kate.
Sorry,
you go.
I was just. Do you think he's picking and choosing his constituents?
I'm not going to comment on that, Pete.
Well, no, but I mean, is the argument? I mean, there's obviously a political dimension, even if we're not. This isn't a political broadcast, and is he basically saying that he feels that the people that will benefit from some of the positives, like the 2% off NICs and some of the other stuff we're going to talk about, are more likely to vote for his party than the people who own furnished holiday lets? It just seems a slightly odd equation. That's all.
Yeah. Kate, sorry.
I mean, I completely agree. It's quite a ludicrous decision. The benefit of furnished holiday let back in the day was that if you made a loss, you could offset that loss against your income. That got taken away. So the main benefit now is obviously, like you say, the business asset disposal relief, various other trade and reliefs. I know John has put a question in talking about what are the other consequences. So you're going to lose your interest. So you would have got full interest relief on an FHL, whereas you're now going to be within the interest restriction on a residential property. So that is another point. And I think as well, furnished holiday let income counts as net relevant earnings for pension contribution purposes, whereas a normal rental property wouldn't. So they're the other things to consider. Interestingly, in terms of capital allowances and losses, there isn't anything released to say what will happen to any pool that you might already have. So if you've got a capital allowances pool brought forward on a furnished holiday let, where will that go, or how will that be treated when it converts to a normal residential let? And the same with your capital losses, because actually we've got quite a lot of clients that will potentially benefit from this long term, because they're actually making a loss on their furnished holiday let every year, but have profits from other residential buy to let. and they can't offset them losses because they can only offset them against the furnished holiday let, and they haven't got another one. So actually, going forward, it could benefit some clients, but where you've got a large loss carried forward, I can't fathom how the revenue are going to allow that to just come through and be offset against normal rental profits. So it'll be interesting to see how that gets treated going forward. Definitely.
Yeah, there's got to be some transitional arrangements here, haven't there? Especially good point on the capital allowances. I mean, I'd have thought most FHLs probably going to be within the annual investment allowance, aren't they?
I mean, you would hope so. You would think that they potentially haven't got a pool, but some of them might have historic pools brought forward from early years, but it'd just be interesting to see what they decide to do about that or where that value goes. But I know certainly I've definitely got some furnished holiday lets that have got losses brought forward, rental losses of sort of 40,000, 50,000. And you think, well, they've never been able to offset them. So where are they going to go? So it'd be interesting to get the detail on that.
Yeah, and Pete, there might be some more work for us with property portfolio incorporations with finance cost restrictions no longer being available. So we'll see how that happens. Yeah, okay. So FHLs, yeah, I think that's a fairly significant one, even though I think we might have a slight negative view on it. Moving on, another property issue, multiple dwellings relief. So we're into SDLT territory now. So that is being abolished from June 24. So yeah, that's an interesting one. Caitlin, shall I bring you in to talk about this one as well?
You can do, yeah. We do actually see it a lot. We see it a lot where people are buying more than one property, either company or individual, where they're perhaps buying 6 properties in one go. Or what I personally see a lot is where people are buying a larger property and it's got, what's typically called a granny annex or another dwelling that's within the grounds a bit. I'm surprised they've abolished it. It does get, I say, abused legally, but it does get abused a little bit in the fact that they've never, you could buy a property for £2 million and an annex could be worth 20,000 of that. And there's no apportionment. They just allow you to split it straight down the middle. So I would have expected them to make it fairer in terms of valuation. But I certainly wouldn't have expected them to get rid of it completely. But they haven't changed mixed use, which I know me and Pete were talking about earlier. And the mixed use stamp duty relief is a really advantageous one. And that too, it also seems a little bit too generous at times. They don't seem to have thought it through, but they've left that alone for now, which is good news.
Well, they've actually published the results of the consultation today. And what the paper says is that an awful lot of correspondents, while perhaps recognising that it might technically give a fairer result, would substantially add to the administrative burden when you're buying mixed-use property, which may or may not be true. I mean, I can't help feeling that the vast majority of genuine mixed-use purchases are going to be for a business, or where a business is buying, premises that happen to have some accommodation on or something. It seems unlikely that the average private landlord would be, or private buyer would be caught up in this. But anyway, that's the reason that the government decided not to go forward. And there was a bit of a side message that HMRC has been reasonably successful in defending their position in what they consider to be the contrived mixed use cases, which are basically, tax avoidance. So from that perspective, there isn't a need for a change. But I must admit, I mean, an apportionment, again, would seem to me an excellent way of raising funds while also being seen to be fair in the wider context. If you buy a piece of land that's 50% residential and 50% commercial, why shouldn't you pay the residential rate, the higher residential rate of SDLT and the 3% surcharge in respect to the value of the residential component? And it's not generally like the government to shy away from imposing compliance burdens on the public, is it, really?
Yep. So yeah, we've got some SDLT changes as well. The final property change is the capital gains tax on residential property. So I can't honestly remember the date, but when I first started out, we just had 18 and 28% CGT rate on all assets.
Oh, you're so
Then
young.
I know. At some point over the next few years, it changed to most CGT was 10 and 20%, depending on whether you were basic rate or higher rate, but they kept residential property at 18 and 28. Today they've announced we are reducing from 28 to 24. I was really hoping, as he was talking, and he said was talking alluding to the CGT on residential, I was thinking just align it with everything else, make our lives simple. But no, we're down to 24 for higher rate. Basic rate taxpayers will still incur 18% on the element that falls within their basic rate band. So yeah, I mean, Kate, I don't know if you think this is going to have really that much impact on things.
It's not going to have a huge impact. I mean, I'm obviously older than you, because I remember when it was 20% or 40%. So if you were a higher rate taxpayer, it was always 40%. So it's certainly better than it was. I'm sure a lot of people will welcome that 4% drop. One thing that does spring to mind, because they've said about it being from the 6th of April, I know certainly if I was selling a property now, I'd be delaying that completion to make sure it happened post 6th of April. Although you have got a drop in the capital gains annual exemption after the 6th of April, so it would very much depend whether you were going to benefit from a higher exemption this year enough to warrant that change. It would matter how much the gain was. But yeah, surprising. Like you say, it would be nice if they'd have just aligned it, but I think they've got to put some sort of penalty in there for residential property, which has always been the case for sort of the last 10 years. So I think that's why they're trying to keep it different, just to put that sway onto it, really.
Yeah, good point. I mean, one other thing that's worth mentioning is that the PPR still nothing's changed on that. So your main home remains fully relieved in most cases. So we are only talking about the second properties and things here. Pete, I think it was you I was talking to earlier, and we were talking about the link with FHLs here as well, because obviously if you sell an FHL business, it can't just be a single property. But currently, if you sell an FHL business, you'll pay potentially 10% CGT on the whole lot, whereas now, once the FHL regime is being abolished, you'll pay potentially 28%, but now down to 24. So I guess there's some small mercy for FHL owners, isn't there?
So I think that's right. I mean, there's a window for FHL owners, if they're individuals, to sell the properties off as quickly as possible. But then, of course, do they want a fire sale? Well, I guess even on fire sale prices, paying 10% might give them a better net than 24%. I mean, if you're a company, so if you've got a corporate FHL, I guess it's slightly more difficult, isn't it? Because unless you can persuade somebody to buy the company and you can claim 10% business asset disposal release, which I assume you can, the company is basically just going to pay a corporation tax rate. So what's the difference?
Yeah. Now, as you were talking, I was just thinking, okay, so what happens if you sell all the properties within the company and then you wind it up? Presumably, you've still got 3 years and you can claim BADR because it was a trade, as long as you sell it.
Your 3 years after you stop trading.
Well, no, it doesn't actually say that, because the interesting point is, of course, it says from ceasing to be a trading company. So
it does, doesn't it?
So in a sense, if you've got your cutoff date when FHLs are deemed no longer to be trades, that is the date it ceases to be a trading company without becoming a member of another trading group or whatever the qualifying issues are in the legislation. But it actually means it's not when you've sold off your last property, which kind of would be the normal when you cease to trade. It's actually when it stops being deemed to be a trading company. So if you can sell off all the properties in that 3-year window and get it into liquidation and get your first main distribution out within 3 years, that's what you need to do. Unless, of course, they put in some kind of transitional arrangement. If they turn around and say, and therefore, as of this date, they will be treated as never having been a trading company, for example, so that you can't then do the wind up and claim you used to be one. Who knows?
Yeah, that would be a bit harsh for people expecting 10% when they're closing down to But yeah, we'll
Yeah,
see. We'll see.
but in a sense, if you've decided the policy is these things should not be treated as trading companies, then is there an argument that says so once that change has been triggered, why should we offer you business asset disposal relief because you wind it up rather than selling it? Or
Yeah.
whatever. It may not be the answer, but anyway, we will wait and see. But, you know, is there no end to their deviousness? No, is the answer.
Right. Let's move on to some business tax, because we haven't really touched on companies yet. And so the first big thing, well, I say big thing, well, I'll explain why I'm questioning whether it's actually that big a thing. Full expenses and capital allowances. So Lucas, let me bring you in here.
So we were quite excited about this for about 15 seconds.
and then we saw the detail.
Yeah, so it can be extended to companies that lease out their assets, which always seemed quite unfair. That, you know, almost like this inference that if a company leases out assets, it's not really a trading company. You know, it shouldn't have the same reliefs. So they said they're going to extend it to allow it for companies to lease out assets. However, they've said they're going to bring it in when it's affordable to do so. So that doesn't really mean anything, does it? So it's like it's a non-comment. It's, you know, it's highly likely never to come in fact.
Yeah, I mean, what they did, they made it permanent. So it was in as a temporary measure. So a full expensing is very much like first year allowances. I hate the term because you can't expense it. You can't put it through your P&L. All you can do, I say all, or you get capital allowances of 100% in the first year if it's main rate stuff. And one of the main exclusions is that if you lease out the asset, you can't have it. They made it permanent in November 23. Then they said they're going to extend it to leased out assets today, for which we've certainly got at least one or two businesses that specifically do this type of trade. And so it was a really beneficial allowance for them. And then they said only, and actually the words in the red book say when fiscal conditions allow, and we'll publish draft legislation shortly. So, I mean, in reality, fiscal conditions aren't going to change in the next 6 months or so before a general election, are they? So,
yeah, so a bit hollow.
We had hope for a while, didn't we?
Yeah.
But we did say something similar back in November, didn't we? We actually said, you know, this full expensing being made permanent really means till the end of this Parliament.
Yeah, that's true.
Yeah.
And then we wait and see.
I think just on, you know, that comment about when fiscal conditions will allow, I think pretty much they said that Jeremy Hunt had a £13 billion budget. But then if we take into account 3 interest rate cuts by the end of this year, that would actually reduce the cost of government borrowing and actually give him £23 billion. So what can they do really? They talk about bringing inflation under control quicker than expected, but obviously that's just a projection. We don't know what's around the corner, but obviously they will follow central bank policy with regards to reducing interest rates, which will then give the Treasury more monies to spend, and maybe that's what that comment was alluding to.
Possibly, yeah. Good point. Yeah. So full expensing, we're excited, not so excited now. The other, I think, main thing to comment on for businesses is VAT. So again, this is another one that people were thinking might happen, and a lot of people seem to be proposing £100,000 threshold. But what they've now said is it's going from 85 up to 90,000 from the 1st of April 24. I mean, Lucas, do you think this really is that big a thing?
It's a real game changer, isn't it? £5,000 increase.
I mean,
there's no zero effect in reality. I think that level is just token gesture, isn't it? But they've increased. I don't know how much actually Admin is going to save, or how many businesses will come out. They gave a number, didn't they? The number of businesses will benefit.
28,000.
We'll see.
Yeah, I think the what I was reading was kind of it was about.
It doesn't make economic sense.
To go and Pete.
Yeah, but none of it makes economic sense. I mean, the VAT threshold should be somewhere around 20,000. like it is in other European countries, or some, I believe, don't have a threshold at all. It's just everyone pays VAT. But the problem is, by having it as high as we do, you get traders who are doing quite substantial business, obviously turning over 85,000 a year or up to 85,000 a year, saying, I'm 11 months of the year in, I've got to 84,500. I think I'll stop working for a month.
Yeah.
Which is kind of counterproductive. And obviously at that level, this increase might let them work that extra month, but it's just shifting the burden. And actually, the economic answer, at least the answer given by a great many economists, obviously there will be different opinions, is that the number should be left well alone, so that in 20 years' time, it's a very small number in terms of, just general inflation, rather than being constantly increased.
Yeah, and Kate, you also said something when we were watching it about the kind of actually a £5,000 increase when you actually think about the cost of living and what people should be putting their prices up by. If they're trying to stay at 85 to not have to charge that extra 20%, it's not very helpful.
Yeah, because you think, I've got friends that run their own businesses, and I know for a fact that their turnover has gone up, but so have their overheads. So although their profit hasn't gone up or their profit has gone down, their turnover's gone up massively because it's had to keep up with the overhead. So I just think if that was what they were trying to do, to relieve some burden for small businesses, £5,000 doesn't, it doesn't even touch the sides, I wouldn't have thought, of what anyone's turnover has had to increase by.
No, not at all. I think that kind of covers some of the main points that we kind of wanted to make everybody aware of. There's been a notable absence on this call from David, so I thought I'll move on to kind of what was missing, what maybe we hoped for, and David, in the corporate finance world.
Thanks.
Was this a good budget, a bad budget? We were thinking.
I think it's quite a good budget because it didn't touch any of the main provisions. BADR was left alone, and stamp duty on script on shares the same. I think if they increase the lifetime allowance on BA, that'd be well received. But I think it's unlikely that'll happen in the short term. Both governments have said they're not going to do too much of BADR, so the opposition and the government, other than tinker. So I'm hoping there won't be too many changes for that. The good news was the economic growth figures are increasing, and although there are projections, hopefully that will bore through, and we will. And obviously the declining inflation agenda makes the debt market a bit looser, as in it tightened badly last year. So all in all, without anything actually happening in the budget, it was pretty good from a corporate finance point of view.
Yeah, fair enough. Mark, have you got any extra comments on sort of in the mortgage and finance world? Are you relatively happy or?
Yeah, well, not really, but as I said, I'm still annoyed about some of the actions today. But coming back to one of the comments about the OBR saying that inflation seems to be dropping to 2% quicker than I appreciated that it would, and as David rightly said, that affects the capital markets. We've had fluctuations. Products coming out one week being withdrawn the next week because the long-term swap rates were just up and down. So hopefully we noticed when we got some consistency of base rates not rising for 3-4 months in a row, we got more activity. So if we start to see rates come down, it'll be good for us. It'll be good to see. We believe there'll be more activity, and sooner rather than later. But with the Bank of England's again to be Mr. Doom and Gloom, given the Bank of England's track record of getting it so wrong, it'll probably be a drop later rather than sooner.
I thought we were doing quite a good job this time round of being quite, well, not necessarily positive, but certainly not that negative. So maybe I shouldn't have just brought you in on that bit.
No.
Last time we were very negative.
It's having a Welshman on the panel, as Lucas said earlier. You should invite the Welsh on the panel.
Kate, anything else?
That's it.
Yeah, in terms of things that were missing, I think in the last few budgets, we've seen the exemptions get slashed quite massively. So the dividend allowance is due to drop to £500 a year from April. The capital gains exemption is due to drop to £3,000 from April. Both of them factors have just seen a massive capture of the amount of people that need to now do self-assessment returns that didn't before.
Yeah.
So we're seeing clients where they've perhaps just got, some savings in a growth portfolio or a stocks and shares portfolio. And actually for them to make a gain of less than £3,000 a year, I mean, they'd almost have to be trying to make a loss to stay within that exemption. So you're seeing so many more people come within self-assessment. And to be honest, HMRC's infrastructure struggles with the amount of people in self-assessment as it is. You've got people that have got little dividends, from BT shares or Severn Trent shares that they've held for years. And those dividends are more than £500. And all of a sudden they're within that regime. So I was hoping that they'd perhaps come to this realisation and seen an influx of people registering. And we're going to do something with them allowances, but they haven't shifted, which is a shame. It's a massive burden for a lot of them are elderly people that have never done tax returns all their lives. They're not wealthy people by any means. And all of a sudden they're having to use a professional advisor to do a tax return for them. It seems a bit unfair.
Yeah, we didn't have anything on IHT either, did we?
No, and I mean, the IHT threshold, there was talk of it being abolished in the last budget, which I don't think they will ever do because, quite frankly, I can't imagine how they could possibly afford to lose all the death taxes in this country. But that £325,000 threshold, I mean, that's been in place God knows how many years. It's frozen until 2026. It used to be, 10 years ago, if you had an estate of 325,000, you were in a fortunate position. Property prices, wages now, it's just not the same world. And that 325,000 is so small that most people are over that limit already and into that inheritance tax threshold. So I think they do definitely need to look at making that exemption a more reasonable figure, really, for taking into account the world in which we live in now.
Yeah. Absolutely.
Yeah.
Jamie, sorry, I think I cut you off before, Kate, so let me pass to you.
No, yeah, just to echo what Kate said, really. Obviously, more and more savers who are paying tax on their savings interest. So if you're a higher rate taxpayer, you could be paying 40% on your savings interest, which when you look at the headline rates of these products, i.e. being 5%, well, then you're actually only receiving 3%. Sometimes there's the need for simple self-assessments. So that just highlights the importance of utilising those funds and utilising your ISA allowances. As financial planners, we work with our clients on long-term, with regards to their long-term planning, whether that's saving for retirement, knowing their exit figure within their number, or whether that's maximising their legacy. Cash obviously does guarantee a return, but that is a sub-inflation return over time. So that's where we, invest our clients' monies to try and outperform inflation over the longer term. And just on that point, it's reassuring to see, compared to Liz Truss and Kwasi Kwarteng's FAUD budget, that, sterling has actually held relatively stable. There's been a slight increase in the FTSE. So, it was well received. And I don't think anybody had any intentions that Jeremy Hunt would do anything that could potentially crash the bond market, because that was, it's terrible for a lot of people, especially who hadn't reviewed the underlying investments and were overexposed to gilts, etc. So all I would say is, if you've got savings and investments, obviously ensure they're well diversified and not overexposed to one specific sector or asset class as well.
Yeah, absolutely. Pete, I am coming to you, I promise. We've just had one last question in, which I'm going to turn to Kate to. Will anything change to the IHT position on FHLs?
Yeah, I mean, historically, people have always thought that FHLs automatically qualify for BPR because they're a trading asset. The reality is they don't often qualify. You have to provide a lot of services. So if you've got, let's say, your likes of, Haven or something like that, but on a smaller scale, you've got to provide a lot of additional services to make it a business for BPR purposes. So the large majority of just, a holiday house in Devon or a holiday house in Cornwall that you rent out wouldn't have qualified for BPR in any case. they certainly won't qualify now, and that will be regardless of whether you provide a lot of other services with it or not. So any that did qualify, where you do provide, you know, breakfast or a laundry room or other services like that, where you could have really argued the trading point, they certainly won't qualify for BPR going forward. So yes, you know, technically the IHT position is changed, but I think it would only affect a very small amount that did qualify before anyway.
So just to wrap this up, we were going to save some time for questions at the end, but we've kind of picked them up as we've gone, so which hopefully has worked quite well. I'm just going to turn to Pete. Pete, there's a couple of things that are worth noting. We've got potential regulation of the tax industry, and then a couple of other notable absences from today.
Absolutely. So without going into a huge amount of detail, we've talked a lot in our predictions, and indeed our predictions for the November autumn statement, about changes to the employee ownership trust regime, and also about a new regime to replace stamp duty on documents. So nothing to do with stamp duty, land tax on property. Both of which were widely consulted upon. Both consultations ended last autumn. So they've now had many months, 6 or 7, maybe 5 or 6 months, sorry, to review the position. But so far, no announcements of any changes. I don't know if there's anything significant in the fact that we've been, there's the new next tax administration and maintenance day has been announced for 18th April. It is possible that some kind of announcement in respect of both EOTs and stamp duty or one or other will happen on that date. But there's no indications that the government has gone away from those reforms. And the last thing, yes, as you mentioned, Nick, although it's not strictly part of the budget, there was a consultation document published today, consultation running till 29th May, about regulation of the tax industry. I haven't had time to read through it in detail, but the headlines seem to be 3 possibilities: either requiring everyone who gives tax advice to be a member of an institute, or some kind of hybrid joint regulation of the industry by HMRC and the institutes, the professional bodies, or possibly a separate government body to regulate the tax industry. So I suppose the fact of this conduct, which won't have been put out by HMRC in isolation of the rest of government, perhaps suggests that the day has come when we are going to become regulated. And I think obviously the biggest issue is going to be, what do you do with people who are tax advisors of long standing, but perhaps without any formal professional qualifications? And I'm not saying whether they're necessarily good or bad, but I can promise you I know plenty of extremely competent tax advisors who've never taken any of the formal tax qualifications that have been available. So that's a wait and see, but I think everyone in the tax industry ought to read the consultation document, and hopefully a very large proportion of people will respond to it.
Yeah. I'm going to bring everyone on. We've had one last question, and I'm not sure anybody's going to be able to answer this, but given this budget, who do we think will win the next general election? Anybody
Can
want
I
to
say my money is on Manchester City. Oh, sorry, I misread the question.
Well, I think that's probably as good an answer as we can give on a podcast or whatever to the general public that's meant to be non-political.
Yeah.
So
I don't know who designed the colour scheme for the backdrop, by the way.
No comment again. No, so I think that brings us to an end. Hopefully that's been informative. If anyone's got any more questions, please don't hesitate to contact us, your normal Jerroms contact. We're always obviously happy to help, and you know how this budget might affect you. You know, we can chat those types of things through. So thank you very much for joining us. I think the recording of this will be available on social media at some point in the next 24 hours or so. And thank you to Pete, Lucas, David, Kate, Mark, and Jamie as well.
Well done, Nick.
Thank you, Nick.
Well
Cheers,
done.
Nick. Thank you.
Cheers.
Thanks.
Bye.